Everybody has their own unique risk tolerance and goals, so it will be difficult to demonstrate an exact example for each individual's unique preferences. There are factors such as profit targets, the entry price, and the use of stop losses. Some may use stop losses, use them to a lower degree, or not use them at all. Support areas identified by fibs can help identify areas where stop losses could be placed. Profit targets can be chosen around established resistance identified by fibs. A more conservative approach takes profits 1 or 2 fib levels above the entry price, and a more aggressive approach takes profits 3 or more fib levels above the entry price. This is aggressive because, as seen before, fibs are more likely to reverse after crossing over 3 levels. The exit price for a profit target can be right at or very near the middle of a resistance area. It can also be slightly below or above resistance. Again, these are all personal preferences. Fibs just help identify a general area and narrow down some finer details. A more conservative approach takes profits as price nears resistance, essentially an L exit. An aggressive approach will take profits later, slightly above resistance. It could be called an H exit. An M exit would be a mix of the H and L exits, and their benefits and drawbacks, since it is placed at or in the middle of resistance areas. The gray regions on these charts represent areas where fib price characteristics have been established, where price has reversed, congested, or stalled. Purple areas mark more clear reversals, more relevant to support and resistance. Red marks the areas where stop losses could be placed, while green areas mark potential profit areas. Everything is a matter of discretion. The choice you make will determine which prices you enter and exit a trade at. The first bullish reversal demonstrates a situation where a large stop loss below a support was the best option. A normal or tight stop loss within support would have resulted in being stopped out of the trade. A support target right at the lows of previous support early in 2018 in the low 320s was ideal, since this was a major recent reversal area that was clearly visible. This past area of support became firm resistance when price returned back to the 320s. It is also 2 fib levels above where the reversal started. That is a normal and healthy reversal, which would only be considered overextended if it continued one more fib zone up without any major resistance. The second reversal didn't require a wide stop. Its upper profit target in the 320s might have been missed if a higher price was set, closer to 330. A conservative profit target was more appropriate. In the third reversal, a tight stop loss would have been adequate, and a very conservative profit target, 1 fib zone above, would have been the safest route. In both reversals, a wide stop would have been unnecessary. However, given that no past reversals occurred directly at the 0.5 fib level, it was best to extend the probable level of support down to the next fib level where clear reversals occurred, directly on the 0.382 level in early 2006. A stop slightly below this level would have been the safest route if a wide stop was acceptable for your trading plan. In addition, a late H entry was safest here because the 0.5 fib level was not a certain support yet. If you were very risk-averse and conservative, you could have opted to place a buy order at the 0.382 fib level, where support was more certain. This meant the order would not have been filled, and you would not have entered a trade with higher uncertainty at the start. In the second reversal, this would not be an issue, since the 0.5 area now became a recent and relevant area where a clear past reversal took place. A high profit target was possible 3 fib levels above, but it was safer to exit in part or in whole at the second fib level, which was the 0.786. In both cases, uncertainty was seen with price stalling and congesting at this level before heading higher. It would be a matter of risk tolerance and profit goal here. This next example is a brief trade with Facebook stock. Although it is not necessary, some background will be provided to incorporate the ideas of combining technical and fundamental analysis with Fibonacci retracements. In terms of fundamental forces at the time, Facebook, the public, and the media began to forget about a privacy scandal earlier in 2018 involving Facebook sharing user information to third parties. However, a quarterly earnings report was scheduled in late July, which brought back some doubt about the long-term future of the company. Technically, price recovered and broke out to new highs with only minor reversals on normal to low volume. It was clearly becoming overextended. As soon as earnings were reported and price gapped down, fibs could immediately be drawn off the high price had just fallen from. At this point, the market was still indecisive, even after this major drop from earnings. Fundamentally, there were still major doubts about privacy issues, and the company was still said to be overvalued. However, almost less than a day after earnings, many began to realize these concerns could still be very true. But the record-setting price drop was too sharp of a move. It wasn't just a normal healthy price move passing 2 fib levels. Instead, price dropped down 4 fib levels. This was very much an overextension, especially given that it happened in a very short time period. Buying Facebook stock as a long-term investment was still debatable. However, the case for a short-term trade grew stronger. A little profitable bounce in price was becoming more probable given the context. Even just one day after earnings, aggressive traders had entered or began planning to buy at prices in the mid-170s, especially around the round 175 mark. More conservative traders opted for entry prices at or slightly below the also round 170 mark, which would have placed it in the upper ranges of the next fib zone below. These were the two most popular plans at the time. Stop losses would vary depending on the entry point and risk tolerance. The red area covers the most relevant price range where stop losses were being considered. Remember, this was expected to be a short-term bounce, and it was still only a day after the earnings gap down. Modest profit targets in the mid-180s were popular. They also just happened to line up with the fib zone in the lower 180s. More unrealistic, aggressive targets were set, one zone higher in the lower 190s. Now let's see how price actually behaved, and where profits were gained or lost. We can see the conservative entry and profit target was the most profitable approach. An early aggressive entry might have resulted in a loss if a stop loss was not wide enough. An alternate route would have been to make a late H entry after price begun to hold and begin moving back up into the mid-170s. However, the opportunity for this would have been very short. If a very conservative plan placed an entry price lower into the support zone in the mid to low 160s, the trade would have been a missed opportunity. Any profit target in the low 180s, targeting the single small 0.5 fib level, turned out to be ideal to catch the bulk of this little price bounce. This profit target also lines up with the basic criteria of a fib level or zone that also lines up with past reversal areas. Price also encountered resistance from the trend line of the small fib. It also demonstrates a case where a fib level crosses with a trend line for a greater resistance potential. If the 190s were a profit target, there would be plenty of time to realize this was too optimistic, and selling most or all of the position was the safest course of action.